Welcome to the RCA Institute webinar for August. I'd like to welcome you. Today we'll be discussing RCA and the IMA's conceptual framework for managerial costing. We'll be talking about how they relate to each other and how much RCA supports the IMA conceptual framework for managerial costing. I led the conceptual framework for managerial costing project for IMA. The goal was to define a core principles for cost modeling for internal decision support. So we'll be talking a lot about that perspective. I'll also give you a good introduction to the conceptual framework as we go through this. If you have a question while I'm presenting, go ahead and use the chat feature. I won't get a chance to look at it until the end, but it'll be there. I have everyone on mute. I'll take the mute off when I finish the presentation so that you can verbally ask questions. And of course, we are recording right now, so I will turn off the recording when we move to the questions and discussion section so that you're not encumbered by that. All right, I always start with this slide. Resource consumption accounting takes most of its core principles from German management accounting methods known as GPK. That provides capacity analysis and management information, very focused on capacity. If you're not familiar with GPK, you're not alone. It's in wide use in Germany, well confirmed by research, but it's been practiced for a long time. It also incorporates activity-based costing and the ability to present the process view when that's valuable and necessary. RCA creates an integrated economic model of operations for decision-making, not for financial reporting, for decision-making. So our focus is internal management decision-making, linking operational metrics to finance in a very meaningful way, and reflecting clear cause and effect relationships between operations and money. So very quickly, I want to give you the RCA modeling approach. I'm going to make it very simple in 3 steps. First thing we do in RCA is we model the resources, their capacity, and what consumes, or if you want to prefer to say, uses them. Second, we model the flow of the resource quantities consumed and the nature of that consumption. And by nature, I mean, is it fixed or proportional, or in a few rare cases, inverse? At this point, we have a cause and effect based operational model. Step 3 is to model the costs that flow with the quantities and, of course, the nature of that consumption. Now, if you can, try to keep these things in mind, because I'm kind of going to shift gears and start talking about the conceptual framework of managerial costing, and we'll come back to this because it's got a very clear relationship to the conceptual framework. So if you're not familiar with the conceptual framework, it is a statement on management accounting published by the Institute of Management Accounting. That's on the left. There have been 2 subsequent SMAs published that kind of expand on it in various ways. The first was developing an effective managerial cost model, and the other one was costing system attributes that support good decision making. And I'll tell you a little bit more about what that SMA covers as we get into the conceptual framework. So the first question you may have is, what in heaven's name is a conceptual framework? Well, before I go into the topic on this slide, all financial accounting standards have a conceptual framework. They answer questions in financial accounting like, do you have a balance sheet or an income statement focus? Which customers' information needs have priority? You know, what is the basis of accounting? Accrual, cash, etc. You know, do you have an asset focus, a liability focus, a shareholder equity focus? There's a lot of choices that need to be made, and the conceptual framework tries to talk about what a set of financial accounting standards does. So the objective of a conceptual framework is you seek to achieve and what you seek to achieve and the boundaries you want to stay within as you build standards or models. So they're normally composed of a couple of parts: objective, scope, principles, constraints, and concepts. Let me give you a little bit more on this. So financial accounting versus managerial accounting, and we've used the term managerial costing because management accounting tends to be used very broadly for all the things accountants in business do. So it makes a little bit more sense to shy away from the word management accounting, as much as I like it, and go to managerial costing. You know, so financial accounting focuses on the principles established to inform investors and creditors in public capital markets, people who don't have the power to demand more information. An owner can demand as much information as they want if they're a real, you know, a substantial owner. Generally accepting accounting principles are truly a social consensus. They're set by standard setting bodies using a process that balances a number of competing interests. Managerial costing, which, as I've said, is kind of a subset of management accounting, but we define it as it informs managers and employees who can and should access any organizational information. It needs to be the truth, operational and economic, not some synthesis that was based on compromise. The truth about costs is found in understanding the organization's resources, their employment and operation. Sorry about that. Well, let's again, this is kind of hard stuff. So what are we talking about? Because I'm looking at this thing differently than most accountants have ever been trained to look at it. This is a diagram from the International Federation of Accountants that I like. So it kind of says there's enterprise financial management, and then there's a couple of things going on. There's financial accounting. So financial accounting, you know, does a lot of stuff, and then there's managerial accounting. And financial accounting and managerial cross over in the area of cost accounting. And the International Federation of Accountants chose to define cost accounting as the costing that was required by external financial reporting. What we're really focused on in managerial costing and in RCA is performance evaluation and analysis and planning and decision support. We don't really care about statutory cost accounting. That's done under financial accounting. What we really care about is getting a true picture of performance evaluation analysis and then enabling planning and decision support going forward. So to do this, I think it's helpful to think about what is accounting. You know, is accounting a law of nature? Is it truly a reflection of absolute reality? Or is it a law of man? And as such, reflects a truth defined by the compromises necessary to achieve a social consensus. So, I mean, it's really both, but which one is which? And as I see it, financial accounting and accounting standards, external reporting, skew towards the laws of man, and managerial costing is purely laws of nature, a reflection of reality. So why a conceptual framework for managerial costing? Why was that necessary? Why didn't we just stick with promoting RCA? And why did we leap to doing this conceptual framework? Well, there's a problem. Where do you go for managerial accounting and costing concepts and guidance? Where do you go? Well, there's guidance on that in financial accounting and reporting standards because they require some cost accounting to meet their needs. There are textbooks. Textbooks tend to teach specific methods. They teach traditional standard costing, variable costing. Some of them teach activity-based costing. One even incorporates some RCA. So they tend to teach them as methods. There's nowhere you can find the universal principles. And that's the problem. Where do you go for the principles if you want to build a better cost model for your organization? It's hard because you're kind of pushed towards specific techniques. And then what are the principles and concepts that compare managerial costing methods? So you got all these methods and people who argue which one's better, but what are they basing that argument on? And that's what we were trying to do with the conceptual framework for managerial costing. Part of the problem is this. There's a whole bunch of lexicons, academics call them 3-letter acronyms in management accounting. And, to tell you the truth, even most management accountants don't understand exactly what the differences are or exactly where to apply any one of these methods. It's been a problem. So we created the IMA conceptual framework. Its statement of objective is and I'm going to read it, the objective of managerial costing is to provide a monetary reflection of the utilization of business resources and to provide cause and effect insights into past, present, and future economic activities. Managerial costing aids managers in their analysis and decision-making and supports optimizing the achievement of an enterprise's strategic objectives. Okay, a few words there. The first word I want to focus on is up there, a monetary reflection. So by reflection, we actually meant as close as you can reasonably come to a mirror-like reflection of the resources and the activities. Cause and effect is critically important because cause and effect is the basis of the scientific method. If you're not using cause and effect, you're into the realm of a social consensus or compromises of reality. And it's only by focusing on cause and effect that you can define something akin to a science. And finally, the word aids in the managerial costing aids managers confuses some people. Managerial costing is an analytic activity. It doesn't tell managers what to do. There's a lot of politics. There's a lot of strong beliefs. There's all kinds of things going on in organizations, but managerial costing aids managers in hopefully presenting very clear, solid information for decision making. So the model, the very simple model looks like this. We have two principles, and I'll define them in a minute. One is causality, one is analogy. You have the organization's resources coming in, and you have information for decisions coming out. So you start with some modeling concepts, and I'll tell you what those are. And you come to perhaps the most important part. You create, using causality, an operational model that you cost. And that forms the basis for optimizing and for your future decisions. So let's look at the principles. First is causality. Causality is the relation between a managerial objective's quantitative output and the input quantities that must be or must have been consumed if the output is to be achieved. So you look at what you want to achieve, that's your managerial objective, and there's some output associated with that, or quantity of output, and you're going to measure the quantities of the input. Now, this happens not only at the big picture, not only at the organization level, but it happens at minute levels where managerial objectives are achieved throughout the organization. It's everything from producing a product, literally, if you get defined enough, to keeping the floors clean and your maintenance up in an organization. Those are all managerial objectives at some level. The second principle is the word analogy, kind of an awkward word. It stands for logical information use, and that's the use of causal insights to infer past or future outcomes. So some of the words that you might consider with this are rational inferences, the law of non-contradiction around things. So it's about building the model and then using the information. And then there are, as I said, modeling concepts, and here's a list of those. And there are information use concepts. And let's talk about those for just a minute. I want to go through them pretty quickly because there's a lot of them, and you can do a whole presentation on any number of them. But and I encourage you to read about these, but let's just take a quick look. So resources are the source of all cost and value. A managerial objective, as I said, is what needs to be accomplished, and there's many, many levels of those. Cost, that's cost associated with the use of a resource or the non-use, perhaps, of the resource. Homogeneity, that's logical groupings of resources. Traceability, that goes to the clarity of a relationship. Capacity, the ability of a resource to accomplish work. Work, what a resource does. Responsiveness, the relationship of a resource to direct output. Is it fixed? Is it variable? I mean, perhaps it could be inverse. Is it exponential? Very important aspect to be aware of. Attributability, the strength of the causal relationship that you're modeling, and an integrated data orientation, data that reflects resources, not just accounting conventions. And on the analogy side, I'm going to let you read those themselves because we're talking about RCA. RCA is very focused on modeling. So then we also have some constraints, as do all other conceptual frameworks. And the constraints look a lot like the constraints from financial accounting, but I urge you to take a look at the language associated with these, not these very short definitions, but what's in the conceptual framework. So I don't have time to go through all of them, but let me, for instance, tackle accuracy. Accuracy focuses on the reflection of concepts in a model, not precise numerical answers. I'll use the example of idle capacity. It's an important element of the concept of capacity. that idle capacity should be identified for management action, not included in a product or service cost. And when I say included, I mean hidden in a product or service cost. So this definition of accuracy is not focused on the specific product cost number, but rather it seeks to ensure that the cost is composed of the correct concepts and doesn't have any incorrect or distorting concepts. When we think about numbers, being accountants, all of us are used to thinking about financial numbers. But remember, the framework talks about an operational model that is costed. This means that operational quantities, non-financial numbers and data, are as important, perhaps more important than the financial numbers. Cost modeling is not purely a financial exercise. It requires a clear understanding of the resources and processes and how they interact. So I'm going to go back to my RCA modeling approach. And what I said in the beginning is we model the resources, their capacity, and what consumes them. We model the flow of the resource quantities consumed and the nature of that consumption, normally fixed or proportional. And at that point, we have the cause and effect operational model. Then in step 3, we cost it. And that's exactly what the conceptual framework says to do. And in doing steps 1 and 2, we try to apply, to the extent an organization needs them, all of the concepts, again, as accurately as they're needed for the type of information any organization needs to operate. So I hope I've given you an overview of the conceptual framework and that you have a feel for it. One of the things that is happening with RCA is this, and it's happening throughout the both in the operational world and in the financial world, this push towards real time and starting to reflect some of these things, really as immediately as is possible. And in many cases, or in some cases, RCA is starting to make that happen. So I'm going to, first I'm going to turn off the recording.